Advanced Techniques for Managing and Exiting Forex Trades. Introduction. Managing and exiting Forex trades effectively is crucial for achieving consistent profitability and minimizing potential losses. As an intermediate trader, mastering advanced techniques for trade management and exit strategies can significantly enhance trading performance. In this text, we will explore various advanced techniques that traders can employ to manage their trades and make informed decisions when exiting positions in the Forex market. Trailing stop loss. Trailing stop loss is a dynamic risk management technique that allows traders to protect profits while giving the trade room to breathe during favorable price movements. The stop loss level is adjusted automatically as the trade moves in the trader's favor. If the price retraces, the stop loss remains unchanged, protecting the accumulated gains. Traders can set the trailing stop distance as a fixed number of pips or a percentage of the current price. Scaling out of positions. Scaling out involves partially closing a position as the trade progresses in the trader's favor. By taking partial profits at specific price levels, traders reduce their exposure to the market while still participating in potential further price movements. Scaling out allows traders to lock in gains and manage risk more effectively, especially during extended trends. Using multiple take-profit levels. Instead of having a single take-profit target, intermediate traders can set multiple take-profit levels at strategic price points. Each take-profit level should align with key technical levels, such as support and resistance or Fibonacci extension levels. By using multiple take-profit levels, traders can secure profits at various price points while giving the trade room to run if the market exhibits strong momentum. Averaging down or up. Averaging down, adding to a losing position, or averaging up, adding to a winning position, is an advanced technique that should be used with caution. It involves adding to the position at different price levels to achieve a more favorable average entry price. Averaging down should only be considered if there is strong evidence of an impending reversal, while averaging up can be used in strong trending markets with proper risk management. Break-even stop loss. Once a trade has reached a predefined level of profit, traders can move the stop loss to the entry price, break even, to eliminate the risk of losing money on the trade. This technique protects the initial capital while allowing the trade to continue running for potential further gains. Time-based exits. Intermediate traders can incorporate time-based exits into their trading strategies. This involves setting a specific duration for the trade, and if the trade does not reach the desired profit target within that time frame, the trader exits the position. Time-based exits help prevent trades from lingering indefinitely and reduce the impact of unexpected market events. Using volatility-based stops. Volatility-based stops take into account the currency pair's average true range, ATR, or other volatility indicators. Instead of setting fixed stop-loss levels, traders adjust the stop-loss based on market volatility. This technique allows traders to adapt their risk management to prevailing market conditions. Paying attention to price action and candlestick patterns. Reading price action and candlestick patterns can provide valuable insights into market sentiment and potential price reversals. Traders can use these patterns as signals to exit trades or adjust their stop-loss levels. Conclusion. Implementing advanced techniques for managing and exiting Forex trades is essential for intermediate traders seeking to improve their trading performance. Trailing stop losses, scaling out of positions, using multiple take-profit levels, averaging down or up with caution, break-even stop losses, time-based exits, volatility-based stops, analyzing price action and candlestick patterns are powerful tools to optimize trade management and exit strategies. As with any trading approach, it is crucial to combine these techniques with a well-defined trading plan, proper risk management, and emotional discipline. By mastering these advanced techniques, intermediate traders can enhance their ability to make informed decisions and achieve greater consistency and profitability in the dynamic and challenging Forex market.